But Greg has a beautiful speaking voice, and he'll put you right to sleep going over this whole thing. All right. Anyway, so market. Where is it? I went through all dinner yesterday. I had dinner yesterday, 3 hours, not one cough. And now I'm back to coughing. It just started like about an hour ago. And I'm like, really? I'm sitting with my tea. That's not helping. Anyhow, where were we? As you can see, I've got losses on my coffee trade because I liked it down here getting close to 95. We went for the KCZ9, that's the December contracts, because we're halfway through the year already. Natural gas was still on the Octobers, which are NGV 19s. And we started about here at 275, and we added another, and then we added another, and now our average is, hang on, let me go to this thing. How do we do that? Now our average is 275 on 3 contracts, down a couple of $1,000 since the open. So not too pretty. Has to get all the way back up here just to be even. But I think this is nonsense. Last week, there was a big build in natural gas. And that's why we have this drop. But you know, in those productionists here, there's a lot of people fracking natural gas. There's a lot of natural gas production, and people think it's going to just be all positive going in. But the export of natural gas is also picking up on the other end, and we're still at generally lows in the natural gas total inventory. So we had one big build. Let me see if I can do this. Natural gas storage, EIA. Speaking of the EIA, we should look at the petroleum status report too. So, what I'm looking at is this. This is a 5-year average. This is where we are now, quite a bit below the 5-year average. We're about 400 BCF below. We had a build of 80 BCF last week. That's a lot. So only 5 builds like that, and we'd be back to the middle of this chart. But the middle of this chart is still the lower end, and last March, natural gas was not as low as it is now. So we're not even there yet, and we're trading like it's all over. Every time you read about more exports coming online, another LNG terminal opening up, this is a long-term story. Natural gas is going to be exporting the crap out of it. There aren't that many new pipelines yet. There's a bottleneck of getting the gas out of the Permian Basin and the other place, Marcellus to the ships. And then there are bottlenecks at the LNG facilities. But also, every time an LNG facility comes on, and every time you start shipping tankers out of the country, those tankers hold massive amounts of natural gas. So you're sending a lot more than 80 BCF out of the country with a tank, with an LNG tanker. So, because it's liquefied, it's incredibly dense. So, it's a question that it'll go up and down. It'll cycle up and down. There'll be a surplus, a decline, whatever. But I like being long here. I think it's a good place to be long. We'll see what happens. As you can see, the average goes sharply up from here. So it's going to be a lot of catching up, not a little catching up, because every time this catches up, this is going to go higher, and it's got a higher line to catch up to. So it won't really catch right up like they're playing it. So we will see what happens. Then we've got the petroleum status report. We'll see how oil's doing. The 10:30 report. Well, actually, it's the same report, so I'm going to just get the 1 o'clock report, assuming it's out. So today's the 17th, and this is April 12th. That sounds about right. Gasoline production decreased last week, averaging 9.9 million barrels distillate fuel, blah, blah, blah. Okay. So production decreased. Crude oil, Okay. Commercial inventories of oil decreased by 1.4, small decrease. They're barely, 2% barely below the 5-year average. Total gasoline inventories decreased by 1.2 million. So a draw and a draw. And distillate fuel inventories increased by 0.04. So basically it's flat. And how do we respond to flat? Let's take a look. Not that well, right? So basically we're sort of drifting along here. Flat is leading to flat trading on oil. I said last week that I like that $2 line to play gasoline because you're coming into a holiday weekend. That's like one of the most obvious plays in the market when that happens. This looks like a good place. You can play the Russell long here at 1572 or 1572.50. I would do that with tight stops. That's not a bad play. Let's see. So where are we here? Silver, as usual, when it gets low, we buy it, and we sell it up here as it hits back towards 15 to get out. Apple plowing along, up another $1.50 today. Very nice. Dollar is flat, so nothing's happening there. It's kind of a know-nothing day. And the markets are doing nothing also. Everything's flat. So very boring. So hopefully you guys have some questions. We'll see what those look like. No, nobody has any questions. Okay. I will just ramble on then. Let's see what we did today in chat. We did important stuff. We did very important stuff yesterday too, but let's do today first. So today, this was a big deal. All right. Look, the Nasdaq's at 8,000, and it seems like, oh, geez, we should need short the Nasdaq, blah blah blah. But you got to be realistic, and you got to look at each component or the top components and try to get a picture of it. Should it really be lower? Is 8,000 really ridiculous? And what we found out actually going over the Nasdaq is no, it's not really ridiculous. Apple. Revenues are up 28%. Profits are up 70% since 2016. So 2016, 2017, last year's profits were up 70% from 2016. And yes, the Trump tax cut is there and helping, but it's still there. It's not going away. Some people took some special write-offs and stuff, but I was watching for that when I was doing this to see if it was some weird thing. So, with Apple at 29.5, I'm not, that's a bit much. 29 times the earnings is a bit much. Even though I love Apple, it's getting to the point where I think I'm like, whoa, okay, I'm not gonna push it long really at the moment. In fact, we just did we just made a move in the money to our portfolio to really take some off the table on Apple. Why am I talking about Apple again? Oh, I had 2 paragraphs here. That's why I didn't have any good way to, do 2 paragraphs. But it was Apple then Amazon, right? Microsoft. Oh no, I see. This is Microsoft. Sorry, that's Microsoft, and Apple got a worse grade because Microsoft's the one that had 70% increase in revenue. Apple was 30% increase in revenue. So, honestly, when you look back to 2016, they're only up 30% in revenues. They were quite undervalued at the time, so they're kind of fair. But you're getting to pay on the ice. So that's what I realized when I was like the 29 times earnings for Apple. Apple's at 20 times earnings. They're an electronics manufacturer. If there's a recession, their business will go down. There's nothing they can do about that. They're not magic. If there's a recession, they will make less money. That's people stop buying things. People put off purchases, and they are an expensive purchase. So I can't be gung ho bullish on Apple here. So I gave them a C, and Microsoft got a B minus. But still, nothing that I would say, oh, these are ridiculous, and you can't possibly pay that. In fact, if Microsoft grows at this pace, then this is very justified. If this kind of growth, 29 times earnings is kind of justified. Amazon is kind of ridiculous. They're about $1 trillion, 90 times current earnings, but growth is phenomenal. In 2016, they were priced at 105 times earnings. Now they're at 90 times earnings, so they've improved by 10, 15% in 2 years. If they improve by another 10 or 15%, they'll be 75 times earnings in a couple of years. That's not terrible. But still, I'm not going to pay that for stocks, so they get a B minus. They're one of the stocks that could take the NASDAQ down if they have a bad report, and quite violently too. As you can see, going from 202, if they go back to 140, that's a huge hit. That's 60 into 202 is what, a third? About a third, 30%. So they could drop 30%. And they're, you can see right here, they are 7.5% of the NASDAQ. So 7.5% is 2 point, they can take the NASDAQ down 2.5% by themselves. 7.5% times 30%, very easy. Google, also very impressive. Revenues up 51%, profits up 57%, very good steady growth, nice company. I don't think an A, but an A plus, I said. But then later, Google is again, I didn't realize that when I was doing the chart, Google is here and here. They get counted twice. It's really stupid. Although with the market cap they have, I guess that was a decision someone made, but I think it's a bad decision. With the decision somebody made, they're counting their market cap. I don't know. I mean, they have a market cap in the realm of $1 trillion, so they belong in this club, and this club is 7.5%, so they're 6.5% combined. And so maybe that's the logic of the weighting with Google, but it's annoying that they have the same stock twice in the index. But not horrible, but annoying. So Google is good. Facebook, A plus. Facebook's the best one of the group. Facebook is exactly why you want to buy a NASDAQ stock. Revenues were up 102%, profits were up 117%, and that's in 2 years, folks. Now, the problem I have with Facebook is where the hell are they going to expand to? They've got 3 billion people using Facebook on the planet. Not regularly, but 3 billion people overall have Facebook accounts. That's half the population of the planet, or it was 8 billion people really, but it's pretty much almost everybody who has an internet connection has a Facebook account. They only have to make a dime off of those people, and they're doing well. So it's not that hard. And obviously selling them advertising, just putting their eyeballs, utilizing those people's eyeballs makes Facebook a very rich company. So rich that Zuckerberg can afford to say, oh, we'll cut down this, we'll cut down that. They're making so much money, it doesn't really matter. And it would hurt their competitors much more than it hurts them. But anyway, so Facebook Facebook's a stock that tells you why you should buy a NASDAQ stock and why this isn't a ridiculous valuation for the NASDAQ. They are only $500 billion, but they make $22 billion in profits, so 25 times earnings. But at that kind of growth, growing 50% a year, that's pretty well justified. You can't. It's really hard to say anything bad about these guys, other than just hating them for other reasons. And that's really spin by the hedge funds and people, is they try to get you to not like Facebook so that you'll sell shares. They want to buy shares. They want to buy them cheaper. And they can't buy them cheaper because so many people have shares of Facebook. So they instead float campaigns of one of the things they're doing is trying to cause problems for Facebook and get them investigated and so on and so forth. It's all part of the game of keeping the valuation down. So the big guys can get it. They would love to knock him back down to 120 and really stock up on this thing. Where am I going to go? Okay, that was Facebook. Google again, right? And then we have, and frankly, I gave him a B for cheating, but that's, it's not that bad. Intel, amazing company, of course, but revenues are up 19%, and where was profits? They doubled their earnings, so earnings are up 100%. Wow, revenues up, and this is another thing about these kind of companies, because they don't need to make more money. They don't need more revenues to make more money. They can sell the same stuff and be more efficient. And that's what a lot of these tech companies are doing, because they are all over the artificial intelligence, the automation, the robotics and all that. They are doing everything because that's the kind of people they are. These companies are run by the kind of guys who love to go to the robot show in Japan and look at all the cool stuff and And they're the kind of guys who, in their mind, easily justify spending $100 million for a production line robot that's going to save them money. You know, you go to, if you did the same thing at Crocs, you're probably not going to find people who are like, oh, that would be really cool, let's get that. It'll pay for itself. You get arguments. You know, I've been in many, many board situations. You know, there's certainly most boards are very conservative. They don't want to make mistakes. They don't want to spend money they shouldn't spend, so on and so forth. So the Silicon Valley companies, though, are all over that stuff, and they're automating everything as fast as it comes along the pike. And they're getting rewarded for it, so they're making more and more and more money. So even though sales may not be up much, they're still making so much more money per sale that it turns them into a really good growth company. And we're only at the early stages of that. I mean, you know, again, obviously, 2 years ago, in 2016, we said we're going 2016 earnings to 2018. 2 years ago, Intel made $4.5 billion. Now they're making $9.6 billion, 100% more money. Effectively the same sales. Sales went from 60 to $70 billion. They also shifted their business. They have more data center work now. That's another big thing for Intel. So they went, you know, not so much chip production as data center work. But, you know, again, it's utilizing the technology to come up with other businesses. They're all entrepreneurial. You know, these guys will totally change their company with the times. And when they see something that can make a lot of money, like cloud computing, which is why every single major company is in cloud, you know, even Microsoft, who's slow as a tech company, they're generally slower than others. That's why Steve Jobs is always killing them, because he's not really a tech guy. It really hurt them a lot. He wasn't growing the company the way it should. Now it's really on good track. But but so you've got you know, you have companies like Intel that they'll spin off a whole new line of business. Intel has a venture capital firm that has a ton of money. They probably got a couple of $1 billion, and they throw $50 million, $100 million at all these small startups all the time. They love investing in new companies. They want to have their finger on technology, and they're very, very aggressive in moving into new areas if they see some profits. Cisco's a bit stodgy. They get a D, and not because of Apple. They get a D because they weren't very exciting. I mean, they went from they went 21% up in profits, and but I don't know, the stock price is up 90%, and 10 billion. Oh, profits up 21% in profits. Revenues. What did I say about this? Their earnings. 49 billion in sales went to 57. No. Oh no, they're flat. They have no increase in sales. That's why it's confusing. They had 49 billion in sales this year and 49 billion in sales last year. They did squeeze 21% more profit out of the same sales, but that's not really that great. And they're trading 20 times earnings, and this is why we don't, you know, play Cisco anymore. It's not exciting anymore. I used to love them when they were cheap. You know, Cisco. I remember in Las Vegas in 2008 or 2009 when they were trading at like some ridiculous thing, like $5 a share or $2 a share, some ridiculous number. And I spent probably an hour like arguing with people about why Cisco is like the best thing you can buy. But you know, we haven't touched them in ages because they ran into their value. So now they're fully valued. This is what they're worth. You know, and I don't want to buy stocks for what they're worth. I want to buy values. Comcast, very boring cable company, but they do a good job. The stock is up 40% in 2 years. Revenues are up 17%, and earnings are up 34%. So, you know, you can't say, I wouldn't give them it's not a B, it's a B minus, but it's very good. There's no reason I would say that's a bad stock or there's anything wrong with it. But look how weird it is what's been happening this year. I mean, these are kind of runaway. Everybody's sort of valuing things at the top. And that's what I don't like about the NASDAQ. Everything is valued. It's like, you know, perfection, basically. And the last one is Pepsi. And again, it's not really a tech stock, but Pepsi also buys machines. They buy robots. They have much better algorithms to tell them where to send their product and who's going to buy the most of this. And, you know, they know exactly where to send the orange soda and where to send the grape soda and where to send. And I know you know where to send the grape soda. But where to send orange soda, grape soda, where to send whatever, where to send Pepsi free. This is, they have artificial intelligence watching every single purchase in the world and making the fill orders, so they don't have to think anymore. The efficiency of that is incredible. They've got machines that are predicting where they're going to sell what when, and they're getting much more efficient at sending the right products to the right places, and that's huge. And that's why they're getting such incredible profits from 6.3 billion. This is a soda company. 6.3 billion to 12.5 billion, 100% increase in profits in 2 years. But here I said it's all tax breaks and one-time gains, so you have to be careful. It's more like 8 billion, and that's still a really nice increase. 6.3 to 8 is 50% increase in profits. Very much justifies where they are, and our revenues haven't moved at all. They're just making more money. And Pepsi is not doing anything new. They're not doing anything they haven't done before. They're selling the same stuff more efficiently. I mean, in fact, if anything, I would say Pepsi is probably the best example of why the NASDAQ has plenty of room to run. Because we could easily have 2 years, 4 years, maybe even 8 years of this stuff ahead of us. More efficiency, more robots, blah, blah, blah. And eventually everybody will be replaced by machines. But that's the downside of it. There won't be any workers, but it's great for the company, and we're investing in the company, so we're not investing in the workers. I wouldn't give the workers a dime. Leonard said, for NG, do you still prefer playing October contract rather than the earlier ones? No, we're playing, we're still playing NGV. I don't play front month because it's too tricky. You can get too burned and you're unrecoverable. When you get burned like this and the contract rolls over, you take your loss and you try again. Whereas with the longer contract, we just let it roll into the next month. We still have our contract, and anytime we get an improvement, we're going to be in good shape. All right, so on the whole, I decided that the NASDAQ is basically in a B to B plus territory. So this top 10 stocks, which is really 9 stocks because Google's twice, they make up 40% of the NASDAQ of weighting. So basically they have the NASDAQ, these stocks, and they are actually all looking very strong. On the whole, there's no reason looking at them to expect the NASDAQ to have a major sell-off. And so therefore, that's not probably something we should be betting on. Now, that being said, the NASDAQ did have a major sell-off. It went from here to here. It didn't take much. It just took a little bit of scary stuff with China and so on and so forth, and we dropped like a rock. So sentiment can certainly change, but the profit picture, as long as this profit picture isn't changing, we're going to watch all these stocks very carefully. If the profit picture isn't changing, then I'll be the buyer when it goes back down here. I won't be dumping out. I'll be looking for the opportunity to get back in because they're justifying this level. They're justifying 8,000 on the NASDAQ. And the NQ, by the way, is about 10% below the composite. So the NQ is about 7,700, while this is over 8,000. We're close to S&P 3,000 now. It's crazy. These are some real big milestones that we're crossing. So I do expect a pullback. It's very hard to go over all these different major things without a pullback. But I don't think it's going to last. I think that these are strong companies that have fairly good justifications for what they're being priced now. As crazy as that seems, and as much as I keep saying I think this is ridiculous, it's easy enough to make a case where it's not really ridiculous. It's easy enough to make a case to say, look, if you have a longer term perspective on this and you think they're going to keep automating and they're going to keep getting more efficient and keep squeezing more money out of every sale, these guys have a long way to run. I mean, let's keep that in mind. I mean, it's, when you're talking about Pepsi, the revenues are $63 billion and the profits are 6.3. They only have 10% profit. Well, I'm sorry, 12%. So they have 20% profit. They get to 25%. They're going to be worth, their profits will be up 25. They get to 25% profit. Their profits will be up 25% of 12.5 billion. And so then Pepsi should be 25% higher. And it's very easy to see where that should happen. There's no reason they can't do that. Their cash flow is fantastic. They're in a great position. And also what's going on here is that because of all this automation, it's not cheap, and you have to devote a lot of people to it to automate these lines and change your production. A small company can't do that easily. They can't take a whole factory offline for a year while they retool it and automate it. They can't have a team. They can't assign a 40-man team to work with programmers to go over their processes worldwide and fly people all around the planet checking on the orders and so on and so forth. And they can't install point-of-sale things that allow them to track all their warehouses in Guam and wherever the hell they have warehouses. This is what Pepsi's doing. This is what everybody who's big is doing. And the small guys are getting further and further behind. They can't compete. And it's going to cause them massive disruptions. All right, but that's a later problem. It's not a now problem. The now problem is that these guys are just making more and more and more money. The small companies are able to do quite a bit of automation and catch up a little bit. But in the end, you just have these big guys just can completely overwhelm the small guys. It's almost inevitable that they're going to wipe out so much of the other companies. We're going to end up with a real global oligopoly, the kind of science fiction people have been warning us about since like the 50s. They've always told us that the internet and robots are going to push all the power into the hands of a very, very small amount of people. That's just an inevitable thing. The person who owns the robots that make all the soda are going to control the soda industry. So Pepsi, let's say, has Pepsi has 100,000 robots and Coke has 100,000 robots. Dr. Pepper has 25,000 robots and somebody else has 25,000 robots. Pepsi is making more money now and puts more money into robots, and they end up having 200,000 robots, 400,000 robots. And eventually they don't have any workers, they just have robots. And you can't compete with that, it's too late. If you still have people and you still need people to do stuff while other guys are completely automated, you are never going to be able to fire the people and automate your platform. And while you're losing market share and so on and so forth, and they're crushing you on price, it's a disaster. And that's what's happening now. We're in the very early stages of what's going to be a massive global oligopoly, which is not going to be pleasant. And we have an oligarchist president who's overseeing it right now. And I think either they're going to put in somebody like Bernie Sanders and we're going to push the other way. The people will rise up and push the other way a bit. But if Trump gets reelected, we've seen the same. But if Trump gets reelected or another oligarchy candidate comes in and takes over, it's probably over. I mean, eight more years like this, and there won't be a chance for anybody to catch up. So I don't want to be depressing, but I see that in the cards. All right, Jared says, what's my opinion of NMM, a beaten down dry bulk shipper? Also tough business. Bulk shipping has been getting hit very hard. Also automating pilotless ships are the new thing. People are replacing their cabins with automated vessels that just drive themselves across the ocean. Not actually complicated, right? How hard is it to steer ship? Your cruise ship, when I go on a cruise ship and we go up to the captain's, I take my kids up to where the captain is, nobody's driving the boat. It's a computer driving the boat. No, they don't actually drive the boat. So, and the cruise ships have a crew because they people freak out, they have a crew. But the cruise ships have a crew because just in case weather comes up, people don't like rough weather. You try to steer around the rough seas and deal with stuff and whatever. A cargo ship, if it's too rough, obviously they're going to steer it to avoid major things, but a cargo ship doesn't have to avoid the rain. When you go on a cruise ship, they avoid any kind of weather. If it's too cold or too windy or too rainy or whatever, they just avoid it. They steer the boat somewhere else. So they're always steering into the best possible weather on the route that they're heading. Whereas, with an automated ship and a cargo ship, they as long as something's not going to tip the boat over, they don't give a crap and they just go boop right through. So that's the future there. So one question I want to know is, where are these guys? But this is, this is effectively a penny stock. So I wouldn't trade it. I don't know enough about it. I couldn't tell you, but if you remind me in chat, I'll be happy to look it up a little bit. But it's a penny stock shipper, and these shippers are really black boxes as far as like, are they making money? Are they not making money? You don't know how much debt they have. $161 million company. You don't know how much debt they have. You don't know what kind of contracts they have. You don't know what kind of obligations they have. All that is what comes, when push comes to shove in shipping, that's what really matters. These guys don't actually make money, but they look like they might make money at some point. It seems to be improving. But these are crazy numbers. Look, other income expenses, 54, blah, blah, blah. Interest expense. There you go. Look, see what they're doing. Their interest expenses ratcheting up constantly. So, yes, they have more ships. They're paying more money to have more ships, and they're getting more revenue. But God forbid anything goes wrong or they start getting lower rates. There's a thing called the Baltic Dry Index. I think it's just BDI. Let me see. And it tells you what rates the ships are getting. Yeah, this is the rates that the shippers have been getting. So as you can see, recently the rates have been shit. They really fell apart, and they went from 1,500 to 600 to 750. 750 does not pay the bills on a ship. So you can hope that that's going to improve. But until we have a trade truce with China, and until this, but that doesn't mean he's going to get it as a little tiny shipper. But that could be to his advantage, it could be to his disadvantage, but who the hell knows? We used to play with some shippers. We used to play with the Eagle. We used to play with that big one that's owned by that crazy billionaire, but I forgot the name of them. God. Oh, well, anyway, there's some crazy billionaire named Economou who owns a shipping company. And it's so random because he would sometimes take all the money, steal is the best word for it. He would sometimes take all the money for his own use, and sometimes he would leave it in the company and show massive profit. So it was completely random whether they would have profits or not, and they really had very little to do with how the business was going, just whether or not he needed money that quarter or not. There's not much you can do about it, like Greek companies and so on and so forth. They're not subject to the same laws as we are. And obviously there's certain SEC regs and blah, blah, blah. But good luck. They're not staffed to keep track of all this stuff. Let's see, profile. Where are these guys shipping out of? They're out of Monaco. So somebody's got some money if they can afford to hang out in Monaco. But, I don't know anything about them, so I couldn't possibly recommend or even not recommend them. I'm just saying, be very, very careful playing with these kind of companies, because there's a lot of moving parts that you're not qualified. Not you. Nobody's qualified to really understand all the different ways that these things make and don't make money. And so these guys are in their 50s. So nobody's like a father or something like that. I don't know how this worked. It says that they were founded. Company's founded in 2007, so it's pretty new. So, I don't know. Monaco's nice, I know that. Monaco's a good place. This wonderful apartment in Monaco. It has like a penthouse apartment, which has a water slide from the top of the spire down into the pool. It's really cool. That's my favorite thing in Monaco. But and the casinos are very overrated, but it's a beautiful town. Anyhow, so that's that. All right, so what else do we do today? That was just the morning post. We talked about the big chart. At this point, given the NASDAQ review, Jean-Luc said, well, what are we doing about these lines? And I said, look, we're going to have to bump these up about 20%. These three, not these guys. They're basically right where they should be. Obviously, they're a bit above their must-hold lines. But these must-hold lines, we're not coming back there. We're not going back to 5,400. We're not going back to 22. We're not going back to 21. So we're just going to bump them up 20%. And we might break the 20% lines, but they're going to start looking like these look above the 20% line. And then it's possible we go minus 10, but very unlikely we're going to go below minus 10 once we bump these numbers up 20%. So we're just embracing the new reality. The tax cuts are here and are probably staying for now, unless somebody new comes in as president and changes things. and money is being made in spades. So there's really nothing to be so bearish about. Everything's very fully priced, but fully priced doesn't mean overpriced. It just means I don't see much upside to where we are now. But that doesn't mean that we're going to go down. It just means that we would think maybe we could take a year or so at this level before the next 25, 50% gains in earnings kicks in on the NASDAQ and drives us to the next level. And of course, if you're starting at 8,000 and you improve earnings by 25%, that's another 2,000 points. There's a huge upside to this stuff if the earnings keep progressing at this pace. So what we're going to do as this goes along is we're going to use this as a base, what we did today, and we're going to see how they are tracking into 2019 and see if they're still putting up the same kind of numbers. And if they are, why would they go down? There's no really good reason for them to go down. This is in an office. This guy's growing pot in his office. That's the new thing now. You can have pot plants just sitting on your desk. Tomorrow, not today. Tomorrow, there's a big ass asteroid that's going to go right by the Earth, between the Earth and the Moon. Between the Earth and the Moon, we are going to have a big giant asteroid probably the size of the space station. And hopefully it doesn't hit anything important. This guy's a vocal anti-gay congressman, Republican congressman, kissing a guy at a club. I hate hypocrites. They drive me nuts. This is smart. The London police had protesters and they shut off the Wi-Fi. I know that would get my kids to leave right away. My kids are not passionate enough about anything to not have to sit around somewhere without Wi-Fi. If the event isn't being broadcast, it doesn't actually exist. So they would have to give up on it. See, trucking is slowing down. Trucking is slowing down. Where's shipping going to be? That's the question. Flight attendants. This is a big problem. Turbulence is getting worse and worse with climate change, and it's scaring people out of traveling. So we got to watch that. That's the thing. Turbulence is not something they can do a lot about. They can see it, but they can't really see it. Like they know it's a turbulent area, but they don't know when they're going to get hit. And I've certainly had more turbulence in the last year traveling than I had in my whole life before that. And I've had terrible turbulence, but I travel a lot. But I'm saying, this year, almost half the flights I take have some kind of turbulence. They're really crazy. Climate is changing. They're saying it's because of the climate change. Giuliani. There are lakes on Saturn if you care. This is great. CRISPR is being used to treat cancer. That's a huge possible breakthrough if we get there. We talked about Gilead, and that was a good trade here. And then we did a short-term portfolio review. That's what I wanted to get to. So the short-term portfolio lost $36,000 since last month. It's supposed to lose money. It's supposed to lose money when the long-term portfolio makes money. So that's fine. It's doing what it's supposed to do. It always sucks to lose money. You never want to lose money if you can't. And we could have mitigated a bit by having a few more long positions in the short-term portfolio. But this is without the changes, of course. You just made the changes today. We start out with $100,000, and it's a year later, and it's at 705, or a year and a quarter later, it's at 705. So you can't complain. It's going to go up and down. And this is what we always do. Now, see, the reason the short-term portfolio is up $600,000 is because, let's take a look at the NASDAQ. In fact, because that's what we almost always have NASDAQ hedges. Or more to the point, SQQQ. So when you look back at SQQ, over the time of this portfolio, what happened? We bought a bunch of hedges. The market crashed. Don't forget, this is the ultra short of the NASDAQ. So we laid in our hedges and we popped from 16 to 22. We said, whoa, that's a big pop. We're going to take that off the table. So we cashed in almost a double right there. Then it went back down here, and we added more hedges in. We were like, holy crap, look at this. And we added more hedges, and then popped again, and we also took money off the table. So by a year, we're already up to like $250,000, $300,000. Then we had the whole basic rest of the year where it went like that. But as it goes up, which is what we're doing right now, as it goes up and up and up, we layer on more and more and more hedges until you get this really big run, and then we cash it in. We decide it's too low. The NASDAQ was too low. We cash it in, and then we ride it back down, and now we're building up again a huge position. We have now a massive, massive short. And it's possible, so we keep making all that money, but it's possible now that we have another one of these giant pops in the SQQQ. Just like we did a couple months ago. I mean, we just had this in the fall. It went from 10 to 20, it doubled. So that's basically a 30-something% drop, or the result of basically a 30% drop in the NASDAQ causes you to have a 100% gain in the SQQQ. So now, once again, because this is how our system works, the more money we make in the long-term portfolio, the more money we put into our hedges to protect it, to lock in the money. And so today, we just added a whole bunch of money into this to push our protection, because we have the $10 calls here in SQQQ, and that's not too far out of the money. But when you're working off a low number like 10, or especially 9, the same 30% move or a 20% drop in the NASDAQ will only give you a 60% gain from 9, which works out to like $16. So we're only going to get to 16. We're not going to get to 21. It's very unlikely we can get to 21. So our hedge has to be closer if we want to really make any money off it. So we keep ratcheting our hedge to keep ourselves in position, anticipating that one of these spikes, which happen all the frickin' time, one of these spikes is going to happen, and we're going to get back a lot of our money that we lost so far. And when it does go, we cash it. And like I said, at the moment, my mindset is that the NASDAQ may have a 20% correction, but I very much doubt it will go anything below where we were in December. So if we get back to a 20% correction and this thing gets up to 14, 15, we are going to once again say that's enough money. We're going to cash it out. And now, since we're dealing with a portfolio that's $700,000, if we make the money we'll make on this thing is like $500,000. We get out $500,000 from our hedges, and they're going to be insane numbers. We have $1.2 million on a $100,000 start portfolio. But it's a very simple system, okay? We hedge as we make money in the long-term portfolio. We take some of that money and we invest it into hedges in the short-term portfolio. Then when the short-term portfolio pops, and we cash in on our shorts, we decide whether we're willing to risk that this is the bottom in the long-term portfolio. And we are. Why? Because, once the market stops going down, let's look at the NASDAQ here. Okay, these are weeklies, so it's a very, but you see, it was clear here. I mean, use the 5% rule, tells us when we have a strong bounce or a weak bounce on the way down, so we're watching it. But when we got to here in December, I started buying like crazy. We flipped bullish on everything, which means we cashed out our entire short-term portfolio, dumped all our hedges. And what's the thing? We were up, of course, we had made it to about $600,000 or $500,000. So we took it off the table. And what's going to happen? Either the market starts going down more and we buy more hedges and we'll miss a little bit of the protection but we have to slap on more hedges really fast. Or if we get a bounce, and we're very sure at that point we're going to get a bounce because we're down 20%. And if you're down 20%, you're almost always going to get a 4% bounce, weak bounce. That would be strong bounce. Sorry, strong bounce. Wait. 20% is 28. Sorry, 4% is weak. 8% is strong. 8% bounce is the strong bounce. So back to basically back to this line would be the strong bounce we were expecting. So since we expected bounce, since it'd be weird not to have a bounce at that point, since we made more money than we thought we'd make, because these aren't random numbers to us. We have a valuation on our stocks, and we decide when we start looking at our stocks and saying, oh no, we're not dumping these. We're going to double down on these stocks. And if we do decide that, we take the profits that we make in the short-term portfolio, put them in the long-term portfolio, and then we buy more stocks that are cheap. And then if they do turn around, we make a bloody fortune. All right, but this year has been weird because we've never had to do that because every single time the market has dipped, you know, here and here and here and even here recovered a bit, you know, and then this big huge dip, it recovered completely, meaning that we didn't need to put money into the long-term portfolio because they all came back. And we used the long-term portfolio's own money to double down on positions. So we got more and more bullish in the LTP every time we had a dip, and we cashed in the short-term portfolio every time we had a big dip, and it ends up we made money on both ends, which is very rare, but there was no sustained downturn. There couldn't be a more perfect situation for these two portfolios. It just can't go better than that. So hopefully, now that we've got massive, well, let's go to the review. Now that we have a massive amount of hedges, we are hoping that we repeat this thing. So here we are with $700,000, $582,000 is cash. We're super flexible. And what do? We roll TNA, the 55 puts to the 65 puts. So in other words, we roll that higher, which means that now TNA is at 65, so we're at the money, and if it drops back to 55, we're 4 times 10 in the money, $40,000. It could go as low as 35, and that would be $120,000, you know, in the catastrophe. So that's nice. We only spent originally, spent 28 minus 8, so we spent about $20,000 originally, and now we're adding 16,000 more to it. To the spread. That 16,000, it's coming out of the short-term portfolio because we have the cash there. But technically, we're looking at the profits of the long-term portfolio and saying, well, what can we afford to spend? You know, we're not looking to bankrupt ourselves hedging, but we made $200,000 in the long-term portfolio, which is crazy. And so we're taking about a third of that money and putting it towards more hedges because we don't really believe in this rally. SQQ, we did something complicated, but basically we rolled, you know, we had the $10 calls, and now we're rolling them to the year later $8 calls, and we're spending net to $42,000 on that. But this is, you know, 400 units, so it's a huge position, and it's giving us $256,000 worth of protection at 1440, which is not a very high ambition considering it's a 3 times ETF. TZA, we have a naked 200 calls, and they're in the money. We have $207 calls and TZAs at 922, so there's no need for us to do anything fancy there. We're only down. We're not even down because we sold these puts, and so the net here is we're down about $3,000. That's nothing. You know, it's a hedge. And you're supposed to lose money on a hedge. If it's a hedge and the stock market is doing well, then your hedge is going to lose money. That's what it's for. It makes money when the market doesn't do well and your long positions don't do well. And that's where we are. But these are, you know, I mean, we're just making these insane gains, and we're locking them in because we do believe it could all vanish in a moment. You know, but again, I become, from today's exercise, I'm a little more confident that we're not going to have a massive 40% correction. So I'm kind of inclined to keep it the way it is. I'll keep adding hedges in the short-term portfolio and keep working the longs. But I am going to start, because it's so much money, I am going to start trying, which I keep saying every month anyway, I'm going to try to take more long-term portfolio positions off the table, or at least take cash off the table if something's too deeply in the money. And I'll give you some examples. We're going to go with long-term portfolio tomorrow. So the long-term portfolio, I see it's 316 in margin on the short-term portfolio. That's nothing out of what we have. The long-term portfolio has a bigger margin, $900,000 in margin. This gives you like, this thing calculates off a 401k margin. But really, since we have, what do we have? Look at that, 189%, crazy. We have 1.4 million, so we really have about 3 million buying power, so we're using about 1/3 of that in margin. You know, but this thing, I can't ever figure out how to make this change. It just does what it does. What Where are we? Long-term portfolio, blah, 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 blah. Oh, yeah. So we're going to look at positions that are up a lot and see if we can possibly take them off the table. Because the more positions we take off the table, the less we have to hedge. So, for example, here's Broadcom, which just, went flying. Broadcom went up nicely, but Qualcomm did even better. Here's Broadcom. It wasn't a big position. It's only going to cost us $788 to close it. We have $8,000 profit on the table. We have to wait until January to get $800 more. We're better off clearing the slot and looking for something else to sell. 67% on DKS. It's $30 put, so they're probably gonna. I don't think I'm worried about them dropping that much. 60% on ALLY, also not worried. Okay, there's nothing here I'm too worried about, so I guess we wouldn't probably take those off the table. Then we look at our REITs. Our REITs are generally, they tend to be flat, but of course they're dropping dividends into our thing all the time, so we're very happy with those. And then we have 49 spreads. I think we already did Apple, or I said we were going to do it, but anyway, the 120 calls are way too deep in the money now. So we cash these. They're $341,000. So we're going to take that off the freaking table. And we can switch to another position. So what's your premise? What's your premise for not taking Apple off the table? It's at 120. I mean, it's at 200. You have 120 calls. Why would you not take it off the table? Oh, because I think it's going to go higher than 200. Well, then I don't need to have a $341,000 position in it. Okay? There's no reason for me to hold a massive position like that. So what I can do, nope. So what's my premise? That Apple's going to go to 120. Apple's going to go to, 220 or 240. Nope, can't spell Apple. A-A-P-L. So, what's my real premise? So I go to June of 2021, so going out more than a couple of years. And I can buy the 180 calls for $42.50 or so. Sorry. I can buy the 160 calls for 53, 54, you don't have to do that, 53, let's say, 53.50. So if I can do that, if I can buy the 160s, I'm not sure if I want to buy the 160s or if I want to spend less, but I'm looking at the 160s. And then what can I sell? Well, I can sell the 220s for $22 or $23, I'd say. So what do we say? We said 53, is that right? The 160s. So 53 minus 23 is 30, and that would be the 160 220 spread. So I have a $60 spread I'm buying for $30, and the 160s are completely in the money. So just like the spread I already have, I get every single penny of upside up to 220. But at $30 at $30 a spread versus 85, I'm taking $55 off the table. So basically, I'm going to be taking about $220,000 off the table, and I got the same upside I would have had otherwise. So what would be the point of keeping that money in play? That's what you have to do, because then if the market goes down, I've got tons of money on the sideline to start making adjustments. There's no reason for me to have this giant position. And that's what you have to do. You have to look at all your positions that are deeper in the money than they should be and say, oh, what can we do with this? Look at the ALB, 65 calls. Very deep in the money at $24, $50,000. We can change that. ALK, not so bad, so we won't do that. BHC, not too bad. Citibank, nothing exciting. I'll just look for who's exciting here. Celgene, we have the 60 calls and they're at $95. We don't need that. Okay, we can change that position and turn it into something that costs us a lot less money to maintain. And you're talking about, taking $30,000 off here, $200,000 off there, $40,000 off here, $50,000 off there. We're going to take $400,000 or $500,000 off the table without giving up any upside. You got to do that with your positions. You've got to go through your portfolio and say, why am I leaving all this money in play when I could have it on the sidelines? I still got the same upside pretty much, and I can then if there is a sell-off, I've got all this cash to jump in and buy things, as opposed to watching it and going, oh my God, I'm getting killed. You don't want to be in that position. You know, Disney, well, we got a spread, so I'm not sure if I do that one. That's a biggie though. Ford is a whatchamacallit play, dividend play. Frontier, no, that's just waiting for something to happen one day. There you go, Goldman Sachs. Yeah, the 150 calls. We don't need the 150 calls in Goldman Sachs. That's crazy. So even if we just close this thing out for $30,000 net and do something else, it's just a silly thing to keep open. Why am I leaving that $30,000 on the table? Look at this guy, $45,000 tied up in Hanesbrand. And it's deep in the money. I don't know how much more we can squeeze out of that. 50 times 5 is $25,000. How much is this spread now? It's 45 minus 78. Well, oh no, it's more. 50 times 5 is $25,000. Yet if I cash this out, I'm getting 45 minus 8. That doesn't make any sense. Get like $37,000. Wow, if that's true, we definitely need to do that. That seems wrong though. IBM, again, very deep in the money, needs to be looked at. I mean, there's massive, massive profits in some of these positions that we could be using for doing other stuff. And not only that though, but because we have these positions, we're forced to do bigger hedges. If we had less positions, we would need less hedges. It's very simple. You know, Whirlpool, very deep in the money, doesn't need to be so deep in the money. WPM, as usual, very deep in the money. It's an amazing stock and doesn't need to be so deep in the money. So I'm seeing a good $500,000 we can take off the table tomorrow. And that's going to be my goal. That's what I want to do. There's no reason to keep all your money tied up in positions. That's the whole point of what we're teaching you guys, is that you can use option spreads to drastically lower the cash you have to put into trades, and that allows you to diversify. It allows you to be better protected. You're still getting the upside, but you've got a partner to take a loss. The short call, if you sell your partner to take a loss, the stock goes the other way. It doesn't hurt you at all. It's free money. It really is. It's the best improvement you can ever make to your portfolios, is learning how to do this. There's no reason, if a stock doesn't pay you a dividend, there is no reason on earth to own it. You will get a better deal, and I'm not saying the same deal. You will get a better deal every single time by setting up a bull call spread than you will owning the stock. And the only thing that you're hurt by is you are limiting your upside. But if you're not hedging in the first place, then that's foolish. You know, you're only limiting your upside based on the idea that you're going to go long on a stock and not cover it at all, and not have any hedges. And if that's how you're playing, I can't help you. That's just stupid. But this system is going to consistently make you, and we have videos to this, so you can look them up on our YouTube channel. Just build the stock one on YouTube. But we have a thing that says the secret to consistently making 20 to 30% on stocks every single year. How? That's what I'm telling you now. Bull call spreads at the money, in the money slightly. Let the other person pay the premium. You have all the upside of the stock, and if it goes down, you will be damaged less than if you own the stock. If it goes up, you will be fully rewarded as it goes up. Okay, not immediately, because you have to wait for the options to expire, but if it goes up and stays up, you're going to make all the money you would have made if you had the stock, up to a certain limit that you've imposed. But when that limit is 30, 40, 50, 60% higher than you were, so what? Take your 30% profit, take your 50% profit, and move on to the next stock. As we're going to do now with $500,000 worth of positions. We're going to take out of our total profit of what do we start with? 500,000. Our total profit is $900,000 in this portfolio, and we are going to take, and that's only since last January, and we are going to take $500,000 of that $900,000 off the table and cash it in. And we're still going to have a ton of upside if the market keeps going like crazy, and we're not going to miss out, but we're going to have $500,000 more to spend on new positions. There's nothing wrong with that. So when you're in a rally that just keeps going and going and going, it doesn't mean you have to stay in your positions. You need to evaluate every single position and say, do I really need to be this far in the money? Do I really need to be this deep? Do I need to have this much cash involved in a position? And if you know what you're doing, 99% of the time you do not. All right. So what else are we doing? Oh, yes, yesterday. We're going to look at yesterday's post. All right. I'm not going to do this too long, so if you have questions, make sure you ask them because I don't want my voice to get shot again. Holding up good, though. I guess it started in March. So if it's really a 100-day cough, it's going to last until all of March, April, May. It'll be over hopefully in June. But screw that. I'm going to see a doctor again about this because it's like I really don't feel like coughing until June. I'm not really up on that. Oh, I remember the Money Talk portfolio we reviewed right here because we can't change it because I'm not on BNN. Next Wednesday, I will be on BNN. And that's Bloomberg Canada's BNN. And they have a show called Money Talk at 7 o'clock at night every day. It's a half-hour show. And no, not every day. I'm sorry, it's every Wednesday. I don't think they do it every day. I think it's Wednesday. And once a quarter, I come on and I run this Money Talk portfolio for them. And again, we started this one we started back in September of 17. So it's a little bit older than our other portfolios, but also it's up 158%. And the funny thing is we don't touch it. That's what I love about this portfolio. When I'm picking positions for this portfolio, I know we're not going to be able to touch it for a quarter, so I'm very, very, very careful with my selections. And I look for things that I'm really not worried about, that I firmly believe in. Now, we do have hedges. We're going to be manipulating the hedges a bit. So that's going to be changed. We got Caterpillar doing well. General Foods is doing well finally, and they had a rotten start. ABX is actually profitable, which is surprising to everybody. IBM is not doing so well so far, but I love them. They're going to be great. I don't know if I want to add to the position though. We only have 70,000 in cash. We are only using 30,000 in margin though, so we really have a lot of spending power in this portfolio. That doesn't mean though I want to double down on IBM. I kind of am tempted to. I got to think about that. LB, we love these. Notice these are all trades of the year. IBM is the 2019 trade of the year. LB was originally LB was last year's trade of the year, but or the 2018. LB was the 2018 trade of the year, but we ended up officially doing Haynes because we did LB when this portfolio started in October, but I've officially called out that trade at the start of the year in Thanksgiving, and by that time LB had already taken off, so we ended up using Haynes instead of HBI. I never put HBI in this portfolio, though we did have LB already, so I want to be redundant. MJ's marijuana ETF, that thing's blazing along. MU is Micron doing better, and now this is our so again, 3 stock of years in a row. The WPM is our 2017 stock of the year, and this one is a killer. This is, I think, the second time we're in the stock. So we were in for 2017, then we went in again in 2018 because it's just such a great company to pick when it's down on the channel. And so again, lots of money here, but I have to think now. I can't touch this portfolio after Wednesday. We're gonna make our changes on Wednesday on the show, and then I won't be back until what month is this? This is April, so May, June, July. Wait, May, June, July. So I imagine mid-July. Sometime in July I'll be back on the show. Has to write up a whole summer, so I'm gonna have to put a whole lot of thought into this thing for next week. But that's what we're in. So we're gonna see what we're gonna do as far as protecting it or whatever. I may do a lot of cashing out here though, because I don't. How confident do I feel that we're going to go from a gain of it started at 50,000, so 128. We're up $78,000, $79,000. How confident do I feel that I can protect that $79,000 and make 10% over the summer? And if I can't confidently do that, I'd rather protect the stocks. I'd rather protect ourselves and go for maybe some new positions, but I don't want to make a million changes on the show. Also, that shouldn't be a factor, but unfortunately it is. I don't have time to make all the changes I would want to make if I was going to rip the whole portfolio apart. So we're going to have to talk about it, and we will next week. So next week, expect to discuss that in the webinar and be on the way to the show that evening. It's a 7 o'clock show, and we will figure it out from there. But I'm sure in the morning of Wednesday next week, I will be writing up what the changes are going to be for the portfolio. I'll be sending it out to all their people via Twitter and everything else. And then by nighttime, I'm going to go on the show and review the changes. But gosh, I cannot imagine. This is like, I got to really think about how confident I am. Hopefully we'll get some more earnings from these guys in between. But I really got to consider how confident I am with these positions, because 3 months, May, June, and July are 3 rough months to leave this portfolio open and risk those kind of gains. Very, very worried about that. So we'll see. Although these positions are scheduled to make another $150,000 or $130,000 by, let's see, we told you can make $138,000 by the end of 2020. End of 20, actually, oh yes, the end of 2020, the beginning of 2021. So these positions can still double up from where they are. And it goes back to how worried are we that they will collapse compared to how good they are. And I would love to, anything's up $20,000, $10,000. I'm like, I should take that off, take that off, take that off, take that off. Then we'd have more cash, and then we'd have only a few positions, and then we can start with some new ones for much less money. Because obviously these will start with a lot less money than they have now if they're up this much. So I don't know. So it's a tough one, because I just have a nagging worry about the market. And I just, it's easy in the short-term portfolio, long-term portfolio, because we can put on $500,000 worth of hedges. So it'll actually be kind of fun if the market pulls back in the short and long-term portfolio. This portfolio is not really like that, though. Neither is the options opportunity portfolio, which I have to finish tomorrow. Tonight, actually, tonight. I'm sorry, I have homework tonight. Yeah, I got to finish that tonight. I'll never get everything done. So in the options opportunity portfolio too, it's a self-hedging portfolio. It's hard to protect. But the advantage in the OOP is that I can make a change on the fly anytime I want. I cannot do that in this portfolio. I'm stuck with these positions no matter what happens for 3 months. It's very tricky. But of course, I've had the same problem all year, and we've done great. But this has been an incredible year where things just have basically gone up and up and up, and any dip is recovered. So we shall see. I mean, it's a very tricky thing. I'm going to answer questions and I'm going to go because I don't want to overdo it. My voice is 50-50 right now. Nobody has any questions. That's fantastic. Good. I'm going to be able to get out of here. Let's see how everything's looking. Oh, Apple seems to have found a top over there. S&P down. NASDAQ down a bit. Russell way down. That's hurting on the Russell. It's not good. Here's Apple again. Why is Apple twice and no Dow? Well, the Dow's barely got 8 compared to the other indexes. Oil's trading off. Brent's trading off. God. All right, now I definitely have to stop. RB's trading off. Natural gas is flattened out. Gold, yuck. Gold's yucky down here. Silver, Apple, good. And where's my natural gas? Oh, there it is. It's down. And coffee. No coffee. Dollar's flat. And KC had no chance to improve. It closed. So KC is way down too. So not that pretty. We'll see what happens. All right. So yeah, sorry it's short today, but I really gotta try to save my voice. The more I talk, the worse it gets. Which portfolio would you recommend for someone starting out a new one, keeping in mind what you said about the money talk portfolio? Whenever we review the portfolios, I mentioned that certain trades are good for a new trade, and that's what I recommend. I recommend picking the ones that say good for a new trade, not trying to replicate a whole portfolio, because as you see in the long-term portfolio, I've got $500,000 worth of stuff I want to pull. So I would say whatever I end up deciding next week about the money talk portfolio, you probably do that from scratch, because I'm only going to leave stuff in that I'm very comfortable with. But a lot of these stocks have already gone up a lot, and they're not full of bargains. These portfolios are full of stocks that have gone. When your portfolio is up 100% in a year, it's obviously not full of bargains anymore. It's full of things that were bargains, and we made a huge gain off them, but that they're no longer bargains, just by the very nature of being up that much. So it's not a good example of stocks. You have to look for new stocks, but even within that, I do often say this is good for a new trade, that's good for a new trade. It's usually a position that's down or losing money, like LB is negative, so good for a new trade because I still like them. GIS hasn't moved much, so good for a new trade. IBM, like I said, I might add to that because I like them so much. Not much in here though. That's the problem. The problem with this portfolio is we've had too much success, and when you have this much success, you got to be a bit more careful. You know, and look, and keep in mind we're losing money on these hedges, but that's fine because we're making money on everything else. So it's really a question of at least waiting and looking for the things that we think are bargains that we are adding to, and constructing a reasonably balanced portfolio from that. And in chat, I'm always happy to answer questions about that. So if you want to ask if that's appropriate or something like that, feel free. When might gas prices peak given the holiday weekend? I think they'll peak on tomorrow, because tomorrow's the last day of trading. Don't forget there's no trading on Friday. There might be trading, but the markets are closed. So there might be futures trading. I don't even know. It already bumped though. I mean, we called long at 2, and at 205, I'm taking my money off the table. Even right now at 204, since it stopped going up, I'm done. But see, this hit 205, that's it. 5 cents in gasoline, that's a huge gain. It's like $2,000 a contract gain. So done. I wouldn't bet it right now to go up more. We had a run. The point about a holiday bet is that between now and the holiday, we expect a bump up. We had a bump up of a nickel. That's quite a large move. Could it move up more? Yeah, but the easy trade was off the $2 line. That's done. Now it's 50-50. It could sell off. It could go up. I still think it might go up more, but not enough where I would call it. You're asking, I'm telling you that's where, what I look at, but I wouldn't call it. I'd rather have natural gas, frankly, down here, which I think is ridiculously cheap. I think gold is actually kind of cheap also. That's also a good one at 1272. So those are the ones I like. I wouldn't go chasing gasoline if it's already had a 5-cent run. 5-cent runs are huge. And you can see these guys are weak. So why would I chase a 5-cent run? And okay, great. All right. So yeah, sorry to cut it short, but I'm starting to lose my voice again. I really don't want to. It takes me like a week to get better, and then it's like a nightmare. Then I do another webinar and I get bad again. So in the interest of having a good webinar next week, let's cut this one short. All right. Thanks for coming, everybody. Have a great weekend and nice holidays. Easter and Passover. So plan to celebrate this weekend. All right. Take care.